Being able to analyze business transactions and to identify their effects on the accounting equation will set you up to grasp any accounting concept. So stick in with me and keep watching. Hello and welcome to the Accounting Analytics channel. In the previous video, we mentioned the accounting equation and its main components. Let's begin today by taking a closer look at the assets, liabilities, and equity. Assets are resources a company owns or controls. Examples include cash, inventory, property, etc. What defines an asset is its ability to generate future economic benefits to the company, meaning the company will use these assets to make money. Let's take a barbershop for example. It got scissors, trimmers, furniture, and other supplies that the barber will use to serve his customers and make money. Liabilities are debts. Businesses everywhere borrow money or purchase stuff on credit. They are called payables because they will be repaid at a certain future date. The three main types of liabilities are salaries and wages payable, accounts payable, and notes payable. Salaries and wages payable are related to the salaries and wages of the employees that has not yet been paid. Now the main difference between accounts payable and notes payable is that accounts payable are short term, they will be repaid in less than a year and are related to purchases from vendors or suppliers on the credit. Notes payable are long term, they will be repaid in more than a year and are related to loans or financing from banks. Equity is the ownership claims on total assets, or what the company owes to its owners. It's equal to assets minus liabilities. It's worth noting that in case a business got liquidated, meaning all of its assets are sold, the creditors will be paid first, and what is left over goes to the owners. This is why in the accounting equation we put liabilities before equity. A few more words concerning equity. The equity account will increase when the owner makes investments in the company, and revenues generated by the business will also increase equity. We will see later in the video an example on this, so hold on with me. On the opposite end, owners' withdrawal of money from the business will reduce equity, and expenses incurred by the business will also reduce equity. After this brief introduction, we are ready to jump into our main topic. The accounting cycle is a series of steps that a business follows in order to record transactions and prepare financial statements. We will be examining each step in future videos. Today, we are concerned with step 1, analyzing business transactions. As accountants, we only care about business transactions that affect the components of the accounting equation. Purchasing a new property affects the assets of a business, so it's a business transaction. Paying salaries is a business transaction. Coming up with ideas regarding the launch of a new product is not a business transaction. Now, after identifying business transactions, we have to determine how exactly they will affect the components of the accounting equation. And this is a very important step you should always keep in mind. I want you to imagine a scale. One side of the scale represents assets, the other side represents liabilities plus equity. If there is an increase on the assets side, for the scale to remain in balance, there must be a decrease in another asset or an increase in the liabilities plus equity side. This is what we call the dual effect for each transaction on the accounting equation, meaning if there's an increase or decrease in an element of the accounting equation, there must be a corresponding increase or decrease elsewhere. Now we are ready to jump into our practice problem and start analyzing business transactions. In this problem, we have to determine the effects of each of the following transactions on the accounting equation. Meaning, for each transaction of the 8 below, we have to specify if there is an increase or decrease in the assets, liabilities, or equity accounts. During the month of March, Mr. Donald, a management consultant, number one, invested $13,000 to open his consultancy business. So he invested $13,000 in cash in the business. So the cash account of the business will increase by $13,000. As we said previously, the equity account increase with investments or revenues and decrease with withdrawals and expenses. So here there is an investment by the owner, so the equity account will increase by $13,000. Number two, bought supplies for $400 in cash. When we buy an asset for cash, we are just exchanging one form of an asset with another. So here the cash balance is reduced by $400 and we create another asset account called supplies and we increase it by $400. Number three, bought office equipment from Ivanka's furniture store on account for $2,000. We acquired another kind of asset this time, but we didn't pay for the equipment in cash, it was on account. So there will be an increase in liabilities by $2,000. So there's an increase in the equipment under assets by $2,000 and an increase in the liabilities account, specifically accounts payable, will increase by $2,000. Number four, received $3,500 in consultancy fees earned during the month. So the company generated revenues. We said previously, revenues increased the equity account. And since we received the money, so the cash account also increased. We increased the cash by $3,500 and increased the equity account by $3,500. Number five, paid $800 for office rent. So we paid for the rental expense. Expenses reduce equity accounts. So the cash balance decreased by $800 and expenses, which is under equity, decreases the equity by $800. Number six, paid $1,500 to Ivanka's furniture store on account. So we borrowed from Ivanka $2,000 for the equipment we got. Now we have to pay back. We are paying back not the full amount, $1,500. So the cash account will be decreased by $1,500 and the liability owed to Ivanka's store will be reduced by $1,500. Number seven, after checking the inventory at the end of the month, found that he had used $50 worth of supplies. So we used $50 of the supplies, meaning the supplies will be reduced by $50, and this is an expense. Expenses reduce the equity, so the equity account will be reduced by $50. Number eight, withdrew $260 for personal use. Again, withdrawals reduced the equity account. And since we took $260 from the company, the cash balance of the company will be reduced by $260. So minus $260 for the cash balance and minus $260 for the equity account. Now we sum up all of these accounts: cash, supplies, equipment, accounts payable, and equity. And we verify that the assets are equal to liabilities plus equity. With the idea in mind, the elements of the accounting equation must always be in balance, like the two-sided scale. You are ready to jump to our next topic, debits and credits. Please leave your feedback or any questions you got in the comments below, and thank you for watching.